So, good day everyone. The topic that I will discuss is all about illustration to costing procedures. So, Mr. Alcantara had the following purchase and sales of shares of the stocks of El Dorado Corporation. So, here are the dates, transactions, shares, price, and cost. So, the cost of the share shall be determined as follows. So, we will be using three methods. These are the specific identification method, moving average method, first in and first out method. So first, assuming that Mr. Alcantara identified that the shares sold were those bought on March 1 and March 23. So the applicable method is the specific identification method. So what is specific identification method? A specific identification method is used to track individual items of inventory. March 1, the purchase, we have 5,000 shares, which is equivalent to 55,150. So, how do we get the 55,150? Shares multiplied by the price. So, we have 5,000 multiplied by 11.03. It is equivalent to 55,150. March 23, we have the 20,000 shares. So, 20,000 multiplied by 12 is equals to 240,000. So, to get the cost of 25 shares sold, we're going to add the 55,150 and the 240,000. They are the cost of March 1 and March 23. 55,150 plus 240,000 is equals to 295,150. So, we have the cost remaining 10,000 stocks, which is 100,000 because of 10,000 times 10. To get the selling price, we're going to multiply the 25,000 shares times 15. It is equals to 375,000. And then we're going to less the cost of shares sold, which is 295,150. So 375,000 minus 295,150 is equals to 79,850. Number 2. Assuming that Mr. Alcantara cannot identify the shares actually sold but retains detailed records of purchase and sales in stocks of El Dorado, the applicable method is the moving average method. So what is the moving average method? Moving average method is the technical indicator that investors and trades use to determine the trend of direction of securities. Under the moving average method, the cost of the share and the remaining shares shall be computed as follows. First, we're going to add the shares. So, 10,000 plus 5,000 plus 20,000 is equals to 35,000. And to get the average of unit cost, we're going to divide 395,150 divided by 35,000. It is equals to 11.29. Next, to get the cost, we're going to add the 100,000, 55,150, and 240,000. Next, we're going to less the cost of shares sold. So, we have the cost of shares sold 25,000. So, 35,000 less 25,000 is equals to 10,000. Then, the unit cost will remain 11.29. And the cost, we have 395,150 less 282,250 is equals to 112,900. So where do we get the 282,250? To get the 282,250, we're going to multiply 25,000 to 11.29. Note that average unit cost is equals to 395,000 divided 35,000 is equals to 11.29. Under the moving average method, the average unit cost of the stock is determined after every purchase. So the cost of ending shares can be computed as 10,000 times 11.29. So number 3. Assuming that Mr. Alcantara cannot identify the stocks and sold, does not maintain detailed records of transaction in the shares of Eldorado. So the applicable method is the first in and first out method. So what is the first in and first out method? So a method which asset purchased or acquired first are disposed first. This assumes that the remaining inventory consists of the item purchased last. So the cost of the share sold shall be presumed coming from the cost of the first 25,000 shares bought. We will going to add again the shares, which is 10,000 plus 5,000 plus 20,000 is equals to 35,000. And the cost, 100,000 plus 55,150 plus 240,000 is equals to 395,150. So, we're going to less the cost of shares sold. So, first, we have the January 1 purchase, which is 10,000. Next is the March 1 purchase, which is 5,000. And the March 23, we have the 10,000. So, how do we get the 10,000? 25K minus 10K minus 5K shares first sold is equals to 10,000. The cost of January 1 purchase is 100,000 and the March 1 purchase cost is 55,150 and March 23 we have 120,000. So we're going to add the shares of January 1, March 1 and March 23. So 10,000 plus 5,000 plus 10,000 is equals to 25,000. Next, we're going to add the cost of January 1, March 1, and March 23. 100,000 plus 55,150 plus 120,000. It is equals to 275,150. So, 35,000 minus 25,000 is equals to 10,000. So that will be the quantity of ending shares. Next is we have the 395,150 less the cost of shares sold, which is 275,150 is equals to 120,000. So the quantity and cost of ending shares are 10,000 shares with 12 peso unit cost and cost of 120,000. So, note that 10,000 and 5,000 shares from January and March 1 respectively are deemed first sold. Other 10,000 shares sold are deemed coming from the last purchase of March 23. Next is the cost of the 10,000 shares in the last purchase is computed as 10,000 divided 20,000 times 240,000 is equals to 120,000.
Illustration 3. Acquisition by gratuitous title. Tax basis is an asset's cost basis at the same time that the asset is sold. In March 2013, Mrs. Lipa received by way of donation shares of stocks of Taal Corporation from her father, Don Bosco. Don Bosco also required the same shares by donation in June 1999 from his mother, Doña Carena, who bought the shares for 400,000 in April 1996. The shares had a fair of 700,000 pesos in June 1999 and 2,500,000 in March 2013. Assuming the shares were acquired by Mrs. Lipa from her father by the way of 1. Donation. Assuming the shares were donated by Don Bosco to Mrs. Lipa in March 2013. The basis of the shares to Mrs. Lipa shall be whichever is lower of. First, 400,000 the basis in the hand of the last preceding owner, Doña Carena, who did not acquire the property by gift, and second, 2,500,000 the fair value of the date of donation, hence 400,000. So fair value is the actual selling value of an asset that is agreed by the paid by the buyer as set by the seller. The tax basis of a gift depends on whether it's sold for a profit or a loss. If you sell a gift for a profit, the tax basis is the previous owner's cost basis because the IRS taxes an asset's lifetime gain regardless of who owns it. If the gift value when you receive the gift or the previous owner cost basis. This prevents the owner from writing off and the benefiting from a loss that occurred while the donor owned the asset. Thus, it is important to record the donor's cost basis at the same time the gift is given. If you acquired if it is acquired by a gift, the tax basis is the lower of the fair market value at the time of gift and the basis in the hands of the donor or the last preceding owner by whom it was not acquired by a gift. 2. Inheritance. Assuming the shares were inherited by Mrs. Lipa when Don Bosco died in March 2013, the basis of the shares to Mrs. Lipa shall be 2,500,000, the fair value at the date of death of Don Bosco. Inherited assets. The tax basis for inherited assets is the fair market value at the owner's death. This may require researching historical values. With the rule, you are not liable for any appreciation during the descendant's ownership, nor you can claim any losses while the descendant held the asset. If the inherited property is large enough for an estate tax, the executor can choose an alternate evaluation date up to 6 months after the previous owner's death, making the tax basis the value on that alternate date. Regardless of how long an inherited asset is held, it's taxed as a long-term capital gain or loss. So, if it is acquired by a device, bequest, or inheritance, the tax basis is the fair value at the time of death of the descendant. Third, purchase or an inadequate consideration. Assuming the shares were bought by Mrs. Lipa from Don Bosco for only 1,200,000, the basis of the shares to Mrs. Lipa shall be 1,200,000, the actual price paid for them. So, if it is acquired for an inadequate consideration, the tax basis is the amount paid by the transferee for the property.